Good morning. It's Monday, the 17th of November, and this is Govindraj Ethiraj broadcasting and streaming weekdays from Mumbai, India's financial capital, The Take. The government of India last week withdrew quality control orders or QCOs on key industrial materials spanning textiles, plastics, and mining applicable on their imports into India. QCOs are mandatory Bureau of Indian Standard certifications for these products, which means each category or subcategory of product or importable commodity has to be certified as meeting Indian quality standards at source, a highly expensive and cumbersome process. So if you want to import steel into India from a factory in China, then that factory has to be certified by the quality inspector here. There is, of course, much more to this, but that's largely the point. Now, this is in effect a non-tariff barrier on imports and is a millstone around India's downstream manufacturers, essentially millions of small and medium enterprises making the goods that most of us eventually buy and use, including at home. Such QCOs exist in many countries, but there seems to have been a certain recklessness with which they were issued, if nothing else. The numbers ballooned from 70 to 790 QCOs in the last decade. Now, the QCOs are also a good indicator of how policy capture by business, whether intended or unintended, has evidently led to some companies benefiting at the cost of others. Leading the pack is Reliance Industries. A report put out over the weekend by Delhi-based trade policy tracker Global Trade Research Initiative, or GTRI, says the Mumbai-based oil-to-chemicals giant dominates terephthalic acid or PTA, monoethylene glycol or MEG, polypropylene PP or polyethylene, and the wider polyester value chain. In the Reliance Industries case, many of these QCOs are believed to have been in effect since 2023. Other companies have benefited too, like state-owned Indian Oil and GAIL, which are polymer manufacturers. Likewise, Finolex Industries and Chemplast Sanmar lead in PVC, while Indorama, Filatex, JBF Industries, and Vardhman are prominent makers of polyester yarns, according to the GTRI report. There are other examples in metals as well. Now, there are import duties or tariffs on all these products too, which keep raw material prices high for downstream industries here. But that's a slightly different battle, as QCOs were ensuring that raw materials could not be imported easily or sometimes not at all. Now, the withdrawal of those QCOs comes on the back of considerable pushback by user industries and more recently recommendations of a high-level committee headed by the government's Niti Aayog member Rajiv Gauba. The Confederation of Indian Textile Industries somewhat sums up the reaction of downstream industries when it described the government's decision as a pro-growth measure and a long-standing demand of user industries. The Business Standard quoted CT's chairman Ashwin Chandran saying polyester fiber and polyester yarn form most of the man-made fiber products, and hence this measure by authorities could contribute to the growth of the man-made fiber segment in India. It also said that removing QCOs would improve the cost competitiveness of Indian textile and apparel products, and it makes it easier to obtain raw materials at internationally competitive prices. Interestingly, even GTRI does not argue for a full ban on QCOs, acknowledging that they are needed, but says that they must be exhaustively researched as other countries do before imposing them, and doing so usually takes a much longer time than it has in many of these recent cases. It also points out that major economies do not impose mandatory national certification on industrial inputs like polymers or metals, as we just discussed. Looking back, it's a little unfortunate that India managed to erect and raise so many non-tariff barriers at a time when it should be dropping both of them, that is, tariff and non-tariff barriers. While India, like many countries, faces dumping of excess capacity by Chinese industry and possibly even poor quality exports, that's unlikely to have been the case all the time. Importantly, a competitive domestic manufacturing industry, whether in raw material or final good manufacturing, would be better placed to take on international competition, particularly in this precarious post-Trump world. The Trump tariff wars may ease off soon, going by the most recent moves to bring down tariffs on food items and fresh deals with countries like Switzerland. There is no doubt that tariffs are now beginning to hurt American consumer wallets and the ruling Republican Party's electoral prospects. But India must continue to draw the right lessons from the new trade wars in reducing barriers and making domestic industry truly competitive and world-class. Indian industry can surely supply and is supplying the bulk of the raw materials for downstream industry needs, whether it's stainless steel or plastics. But it must do so at prices that are globally competitive and thus make the nation more competitive as well. And that brings us to our top stories and themes. Why foreign portfolio inflows may restart soon. Trump starts rolling back tariffs on food products as inflation bites. The shocking fact about US GDP growth. And the latest DPDP rules will mean sea change for consumer-facing companies.
This is the Core Report with Govindraj Ethiraj.
Foreign portfolio investments. Indian stock markets have been a relative return disaster this year, according to Christopher Wood, Global Head of Equity Strategy at Jefferies, who said so in his weekly note to investors, Greed and Fear. Now, this is, of course, not a new point, given that Indian markets, or at least the benchmarks, have mostly been stagnant when viewed from the peak of September 2024. And then other markets, including across Asia, have done much better, also thanks to hot new investment themes like AI and biotech. Wood said in a report quoted in Business Standard that India has only been a relative return disaster this year in terms of underperforming the MSCI Emerging Markets Index by 27 percentage points to date. That's year to date, as opposed to an absolute return disaster. Now, this is because of the continuing remarkable resilience of domestic inflows. Interestingly, he also points out that the biggest risk to the bottoming out of the rupee is the continuing resort to handouts in state election politics, which have been a feature for the past 2 years. He says that the growing populism at the state level is reflected in a fiscal situation which looks much healthier at the center than at the level of the states. He also says that in the absence of such an anticipated cyclical pickup, Indian equity valuations in aggregate will be increasingly vulnerable. And still, one area he says where valuation looks attractive is property. Now, the question, of course, is what could bring foreign portfolio investors like Jefferies back into the markets in a much bigger way, particularly secondary, because many portfolio investors have been somewhat active in the IPO market at a smaller scale. A report by Garima Kapoor at Elara Securities says that while a significant part of foreign portfolio investment outflow has been attributed to lack of pure AI plays or artificial intelligence plays in India and rising geopolitical uncertainties, their assessment, looking at the last 15 years of data, suggests that the key factor influencing foreign portfolio investor appetite for Indian equities is nominal GDP growth, which has shown historically a strong correlation with foreign portfolio investment inflow cycles. According to them, 5 peak-to-trough FPI cycles since 2010 align closely with India's nominal GDP cycles. And weak US dollar or US rate cut support inflows only when nominal growth is robust or Indian equities trade at a relative price to earnings ratio below 1.6 times versus emerging market peers. So what they're saying is that a relatively low nominal GDP growth, that's below India's 25-year average of 12%, attracts flows only if India's equity market is trading below 1.6 times versus MSCI emerging markets. Only once in the last 15 years have FPI flows been sizable at relative price to earnings of greater than 1.6x. Also, the report makes a strong case for financials leading the FPI recovery. According to them, they feel that a recovery in FPI appetite in Indian markets will be led by India's financial sector, which has seen a lot of deregulation by the Reserve Bank of India, which has created a tailwind for uptick in credit growth alongside GST cuts, tax rebates, and cooling inflation. Meanwhile, India's equity benchmarks ended the week higher on Friday thanks to IT and pharma stocks. The US government has now reopened and domestic earnings are looking up, as we've been discussing, and the ruling NDA government won a clear majority in the state of Bihar. The election results did not have much of an impact on the markets as the outcome was seemingly and mostly priced in. The Sensex recovered almost 530 points from a day low on Friday to close 84 points higher at 84,562. The Nifty 2 recovered, finally closing 30 points higher at 25,910. Both indices were up about 1.6% last week. Now, the question of where AI stocks are going continues to haunt the global markets. The latest episode of fragility started last week when shares of some of the sector's leading lights lost ground, according to a report in the Wall Street Journal, which says that AI-exposed stocks fell on Tuesday when Nvidia lost about 7% and then slipped another 3% on Tuesday, and thus has fallen below its $5 trillion market cap milestone, which it hit last month. The Wall Street Journal says that even companies that have posted strong financial results, like Meta Platforms, have fallen, and the Meta stock has fallen nearly 17% since its third quarter report about 2 weeks ago. Palantir, the other AI software company, which had hit a price-to-earning forward ratio of about 250, is down 8% since its fairly strong earnings last Monday, according to the Wall Street Journal. The larger point, the journal says, is that there is far more AI computing infrastructure spending than there is AI revenue, and that gulf is widening by the day. OpenAI, for example, the ChatGPT company, says it's planning to spend about $1.4 trillion in the next 8 years, but is only doing about $20 billion of annual revenue today, and it lacks a clear business model to reach the hundreds of billions it needs within the next few years to keep the spending growth going. OpenAI is already projecting that losses will rise to $74 billion by 2028. CEO Sam Altman of OpenAI said last week that the spending was understandably causing concern and pointed to his plans to boost revenue with new consumer devices, robotics efforts, and an AI cloud computing device, none of which, according to the Wall Street Journal, exist right now. Another source of concern is the high amount of leverage or debt which the AI players are pulling in. Oracle did a $300 billion deal with OpenAI in September to supply it with AI computing power, but it also raised $18 billion through a bond sale the same month. Analysts say that this is a taste of what's coming in terms of growing pool of debt tied to data centers. AI-related companies have already raised about $139 billion through corporate bonds this year as of last month, according to Goldman Sachs, which is about 9% of all investor-grade issuance and 23% over last year. And before we continue, join us for the third edition of our partners Algorand India Summit on December 6th and 7th, 2025 at ITC Gardenia Hotel, Bangalore. Registration link in the show notes, and let's get back to the show. Trump rolls back. President Donald Trump on Friday lowered tariffs on beef, coffee, and dozens of agriculture and food products, which obviously means a sharp rollback of the so-called reciprocal levies, even as Americans have started complaining about rising cost of living and inflation. Trump issued an executive order modifying reciprocal tariffs that were imposed on almost all trading partners in August, exempting more than 100 common food items, including fruits, nuts, and spices. As we discussed in the core report the other day, Trump and his team have surely and steadily begun walking back, possibly focusing first on areas where the hurt is greatest first. The newly exempted products on Friday include many products commonly produced in the US, such as beef, which has risen to record prices in recent months, according to that Wall Street Journal report. Trump's decision comes after much debate within the administration on how to respond to voter dissatisfaction over the cost of living and, of course, that November election where Democrats swept aside GOP candidates with an affordability message, according to the Wall Street Journal. The shocking number. Data centers and related high-tech investment activities have become a key driver of US growth. Current estimates suggest that 80% of the growth in final private domestic demand, that's GDP less net exports, government and inventory in the first half of 2025 came from data centers and high-tech related spending. This development, says S&P Global Ratings in a just released report, is quite astounding. The report says that a large and growing proportion of hardware is imported. Imports of computers and peripherals increased nearly 60% in the past year. And that, of course, links to the overall increase in spending on data centers and high-tech industries. Still, even as the boost GDP from hardware investment is offset by imports, the related outlays on domestically produced software research and development, as well as structures investment in data centers and power supply, are helping to lift GDP growth. So what does this mean? In an exclusive interview, I spoke with Paul Gruenwald, Global Chief Economist at S&P Global Ratings based out of New York. And I began by asking him about, first, the overall economic global growth picture and how data seems to be suggesting that the global economy was not buckling under the pressures of the tariff wars. And then, of course, how data centers were driving GDP growth.
Well, first, I think we generally agree with that assessment. Back in April, when the Liberation Day tariffs were announced, we lowered our global forecast. We were pointing to the risks around U.S. policy uncertainty, and we were very worried about the effects of the tariffs on activity generally. As it turns out, those tariff effects were smaller than we thought originally for a couple of reasons. First, the tariff rates themselves are lower than the original announcement. On Liberation Day, we got some originally high numbers from President Trump, but most of those were negotiated down. I think India and Brazil are the current important exceptions to that. Also, there was not a lot of retaliation. We expected countries to push back a bit on those U.S. tariffs and propose counter tariffs. And with the exception of China, which was largely successful in doing it, most countries didn't push back. And then we've also seen a very slow pass through of those tariffs to consumer prices. When we put all of those together, we've taken some of those downside risks off the table. I know we're going to talk about AI and data centers in a minute, but now we seem to have some tailwinds on the global economy, not just the investment boom, but also lower energy prices, and easy financial conditions. So in the span of 2 quarters, we've really gone from a somewhat gloomy outlook to a somewhat more optimistic outlook.
Right. Economists independently, as well as who were part of, let's say, leading investment banks, were also projecting that maybe there was a lot of front loading that had happened in exports into the United States, and which is why prices were down and it was not really reflecting. So now it's almost 8 months. My first question is really, was there front loading or not, just by looking at the data? And secondly, if we were to look ahead, assuming these tariffs stay, how do things look?
There was definitely front loading. It's very clear in the data for the US. So in the first quarter, we saw a massive surge in imports as firms tried to front run the tariffs. And we also had a buildup of inventories as they warehoused those goods. And the first quarter growth was actually negative because, as we know, imports subtract from GDP. Then we got a big bounce back in the second quarter, growth of close to 4%. So when we look at the first half of the year as a whole in the US, growth was around 1.5, and that's in the ballpark of what we were expecting. We think the tariffs themselves are digestible. That's the term my team used as we were doing our forecasts earlier this year. What was really dampening investment and discretionary consumption spending was the policy uncertainty. And that's not just around tariffs in the US, it's kind of international policy more generally and labor market policy around immigration, and then later down the road, H-1B visa. So there's still just a lot of anxiety in the US that the environment's not conducive for longer term consumption and investment. But, the tariffs themselves look like they've settled down and it's largely manageable. So I think we've gotten through the worst of that so far. And then, as I mentioned earlier, growth looks like it's picking up again. The third quarter looks strong until we stop getting the data. So we're awaiting the final word on third quarter GDP in the US. But the nowcasters and the various real-time trackers were pointing to growth again, 3 to 4% annualized in the quarter. So quite strong and definitely above trend.
I'm going to come back to the rest of the world in a moment, but let's talk about the report that you recently put out on the overall spending on data centers and its relation to driving GDP growth. Now, one of the points that you've made in this report is that almost 80% of the growth in final private domestic demand, that's GDP less net exports, government and inventory, in the first half of this year came from data centers and high-tech related spending. And you've also said that this is an astounding development. Another way of looking at it is it's also a frightening development, isn't it?
Well, it's definitely positive, right? If we've got a data center related investment boom driving 80% of spending, that's going to obviously lift the growth numbers. Our view is also that this is masking some underlying weakness in the economy. So I'll give you 3 points to focus on there. One, if you look at the labor market in the US by sectors, the only sector that's really adding jobs right now is healthcare. We're losing jobs in government, we're losing jobs in manufacturing, and we're also losing jobs in tech, despite the build out of the data center. So the labor market foundation is quite narrow. Same story for investment. We talked about the uncertainty around policy in the US a few moments ago. If you look across all the types of investment, the only one that's increasing right now is investment around data centers. All the other investment categories are flat to negative. And then if you look at the consumption story, and let's remember that the US is a consumption-driven economy where household spending drives more than 2/3 of GDP. The top 10% of households in terms of income and wealth are driving about half of the spending. So if you look at the labor market, the business investment, or just the broad consumption picture, we're on a pretty narrow foundation. So in that sense, we're a little bit worried that we're very dependent on data center investment right now and high income earners to drive continued growth.
If I were to extend my previous question on if it's frightening, so maybe it's a little early to forecast, but where could this end?
Generational jump in investment around data centers. And by the way, this is not just the physical buildings, the data centers themselves. We have to add in the hardware, which are the racks and the mainframes, and then the software, which are the LLMs, the large language models that the hyperscalers are driving, plus the energy. So there's a couple of dimensions here. We're starting to hear more stories in the press about the possibility of a bubble. So I think the focus is on the very elevated price to earnings ratio. So all of these massive investment by these hyperscalers at some point are going to have to generate earnings to justify those asset prices. And then from a macro side, they're also hopefully going to generate some productivity gains and higher growth. So those are the kind of risks we're looking at. We are currently in a forecasting round and we'll be publishing in a couple of weeks and will contain some of that material. But I think a downside scenario in the next year or two is that the hyperscalers, in fact, do not deliver some of the earnings that are priced in right now. So we would have an equity market correction. And then to the extent debt is involved, maybe some stress in the credit markets. That's certainly not our downside right now, but it's a risk we're going to be watching because, again, we've had a very large amount of investment in a very short amount of time with high expectations around earnings, and we'll have to see how all of that plays out.
Just to come back to that 80% figure, is there any contrast with any such period in the past where we've had one sector or one category driving so much of investment? And of course, the next question would be what happened then?
Yeah, well, I think we're all searching for analogies or parallels, right? One way to think about this is the digital equivalent of the interstate highway system in the US. So as we all know, back in the 1950s, when Dwight Eisenhower was president, there was a massive build out of the interstate highway system connecting all of, states and municipalities and ports and everything else in the US. This is kind of the digital equivalent of all of that. These data centers are popping up all over the country on the East Coast, in the South, on the West Coast. And the first one was a public sector driven investment program, and this is a private one. So I'm not sure we have an analogy. And maybe the other thing to think about is these hyperscalers, which are in the end mostly tech companies, they traditionally had a very CapEx light business model, and now they are driving the CapEx for a $30 trillion economy. So that's maybe another question mark we could put into the medium-term horizon because these companies don't have a history of large CapEx build-outs.
Right. So the US data center capacity, according to your own report, represents about 40% of the global total. And we're also seeing big investments happening elsewhere in the world, including right here in India, where we've seen Google, for example, announce with Indian business house a $15 billion data center investment on the east coast of India. And there are many others coming up. And this is AI linked, not just data centers for normal computing and storage. So my question really is, while a lot of what we've talked about so far is US centric, what is this doing to the rest of the world? What could therefore happen subsequently?
Yeah, so there are kind of two ways to answer that question. First is there, as we know, is an AI race between the US and China, the two world's largest economies and I guess geopolitical rivals. We have a lot of information, as we've been discussing, around the build out of data centers and AI investment in the US. We have very little information about what's going on in China. We occasionally get a peek into this with the success of DeepSeek earlier this year. But I guess the best guess we can make is China and the US are probably on parallel tracks in terms of the big build out of data centers and AI. There are some spillovers in the rest of the world. In some of our research, the exports of high tech, both software and hardware from certain EU countries, mainly Ireland and also the Netherlands and Germany. We're also seeing some chip exports out of Taiwan and then Korea and Japan into the US as well. So we're getting some spillovers from the rest of the world on the trade channel. And then, as you mentioned, we also have data centers being built in certain other countries. India is one, so is Brazil. Saudi is another one. Our read on this is that those are going to be mostly country specific or regional and not nearly the same scale as what we're seeing on the US. But again, this is early days. We'll have to see how this plays out. But there are definitely spillovers from the US build to the rest of the world. And there are other centers where we're seeing some AI activity, but it's just not at the same scale as we're seeing in the US. But everyone globally, I think, has got a piece of the action here on the AI build out.
Right. Last question. So we've talked about data centers. We've talked about its disproportionate investment scale and levels that we are seeing led by the US and now in the rest of the world. What's happening in the non-data center economy, global and otherwise?
Yeah, well, we came out of COVID in reasonably good shape. We had an inflation scare. across the globe, central banks raised rates. They're now normalizing rates. But we still have the geopolitics and all the uncertainty around that. So if we forget about data centers and maybe go back to geoeconomics and tariffs and sanctions and the US-China rivalry, we're still moving away from the Washington consensus. I spent many years at the IMF, and the IMF was one of the institutions promoting that view where markets were good, trade was good, capital flows were good, and the government was playing a supporting role. Now we have the government in front with tariffs and other tools of diplomacy. We have even the US taking ownership stakes in some of the larger companies. So we haven't landed on the new post-Washington consensus model. We see that trade is being reconfigured. Geopolitics is still in flux, capital flows. If you go to the IMF and World Bank meetings, which I do every 6 months, most of the world is still supportive of globalization and a rules-based order. But the US, which was central, of course, in founding that world, has partially at least pulled back from its historic position of being the guarantor of the system. So we've got all those uncertainties we're still working through. The data centers we discussed are, kind of masking some of that in the short run, but we still have to come to a new global trading and macro and geopolitical model and, hopefully get all the uncertainties settled out so we can go on to a stronger growth path for everyone.
Paul, it's been a pleasure. Thank you so much for joining me.
Pleasure was mine. Thank you very much.
The new Data Protection Act. India's new Digital Personal Data Protection Act is rolling out, and it defines the operational norms for entities in collection and handling of personal data and protecting individual rights. The final rules have now been put out, and the rules also lay out the practical framework for the Act. And India now has an 18-month runway to gear up for full compliance. And for many organizations, this will involve data mapping, redesign of consent and notice flows, and training programs to ensure compliance. Also remember that these new guidelines and rules will have several aspects that relate to protection for children who obviously are engaging with the internet. I reached out to Nikhil Narendran, partner, Technology, Media and Telecommunications, or TMT, at law firm Trilegal, based out of Bangalore. And I began by asking him who this would affect first.
The timeline that we have is till the next November 2026 and then May 2027 for the whole act and the rules to be enforced. Probably May 2027 is going to be the most important date for most of the rules to come into place. So what really changes for India Incorporated is that they'll have to now start working on an action plan to ensure compliance with the Act. The foremost important thing is that, look, in India, we don't have a culture of data protection within most organizations, which means that you'll have to spend a lot of time identifying and training your stakeholders, which includes legal, technology, information security, the most important senior leaders, including the board members, getting them used to the concept of data protection, probably at some level looking at redesigning products and UI, UX to ensure that it complies with the requirements of notice and consent for data protection. There will have to be an extensive exercise with respect to doing a data inventory or data mapping, which involves the help of lawyers, technologists, and consultants and data privacy professionals, and then sort of create your runway for the next 12 to 18 months to ensure compliance with the Act.
Can you illustrate this? What's the best illustration? I mean, what kind of company will have to go through all of this so as to align with these new laws?
Pretty much every company which deals with personal data in a digital form, which now is, I would say probably 99% of India Incorporated will be covered under the Act. But I would say that those companies which are facing the consumers, for instance, your likes of, e-commerce, where you're providing services online, whether you are selling goods online, even your regular small shops online will also have to comply with this Data Protection Act. But specifically, those companies which face the consumer will have to take the bulk of the load when it comes to the compliance.
And what would be the first manifestation of this? So let's say companies are already collecting data from you and me, and they're storing it, and that is useful because we have renewed transactions or recurring transactions. So what will they have to do as per this new act?
Immediately, they'll have to ensure that the data protection is in compliance with the Act, which is that you need to have a proper notice and a proper consent before they collect the Act. The most important moment, and this is actually a very important moment for the data privacy in India, is the fact that, look, once the Act comes into force, we'll have to inform all the consumers about the data that has been collected already by these companies. And you need to give them an option, sort of an opt-out option, to opt out from the continuing processing of the data. So the companies will have to send out large amounts of communique to its users. You and I will get large amount of communique from various companies, which probably we've even forgotten to whom we have given this data a long time back. And that's going to be one of those watershed moments when it comes to implementation of this act.
Right. And in your understanding, are companies generally geared for this? I mean, will it take like a lot of resources to align with this, or they can do it with existing resources, apart from all the external, let's say, skills or resources they have to bring in?
So I would say that, look, the more developed advanced companies are already ready with this sort of compliance because they would have done it for, both Indian multinationals and global multinationals. They already have some lived experience of going through this process for GDPR and the Singapore data protection law, etc. Whereas the new Indian companies, those companies who are largely just focused in India, they will have to do quite a bit of a uplift when it comes to compliance with the act, which involves hiring privacy officers within the organizations, hiring infosec professionals who have got specialization in data protection compliance. So it'll have to be quite a bit of an uplift for those sort of companies.
Right. And you mentioned the Singapore and the EU, the European Union Act. So as a company, I'm already aligned to those. Then this should not be much of a stretch.
I wouldn't say much of a stretch, but I would say that, look, it's a sort of a plus plus or a minus minus when it comes to some regulations like a GDPR. For instance, the EU GDPR is a very extensive regulation. We have not gone down that route of being very prescriptive. We give a lot of options for the companies to comply with. There will be some deviations. Whichever regime you look at, there will always be some deviations when it comes to the Indian law. And we also have some data transfer restrictions, which is not yet come into force. But once it comes into force, there will have to be some readjustments, a lot of vendor agreements to be re-entered into, a lot of education and training which needs to happen internally. So I would say it's going to be quite an uplift for most companies. But those who have already compliant with, let's say, a GDPR, they will have a much lesser of a job. At least it's likely that culture of privacy or data protection is just already within those organizations. They will have to definitely take a less of a load compared to those who are not at all familiar with this at all.
Right. And there's an authority which will oversee all of this. So when will they start, let's say, moving? And what is the kind of things that they would typically or likely to respond to?
So the authority has quite extensive powers under the Act in relation to even the enforcement. For instance, the user can make a complaint to the authority and the authority then decides to actually enforce the action against a particular company. Initially, what we expect the authority to do is to set the sort of tone for how the enforcement and the guidelines with respect to this will be, because it's actually a greenfield area. And the authority will have to lead the way in coming out with the global best practices, adopt those to India, and educate the companies, spread awareness about data protection within India itself. That's the first step that the authority will have to do. And for that matter, the authority will have to be a very progressive and an independent authority. We hopefully will get a very good authority by way of, which is a mix of technologists, lawyers, and bureaucrats and privacy professionals who will set the tone for the data protection law in the country. The next phase they will have is to, once it is enforced, once it's fully implemented, they will look at enforcing, probably looking at those who are engaging in pretty much intrusive processing of data protection is the one they'll probably target. That's the expectation in the market.
Right. And last question. So as consumers, for example, if I feel that I'm not in full control of my data that I've given to a company, it could be an e-commerce company or some other services company, would I have recourse, or what kind of recourse?
There's typically a grievance redressal mechanism which needs to be put in place by these companies. So once you can approach the grievance redressal mechanism, and if it's not really answered to and you're not really satisfied with the answers that you're getting or the results that you're getting, you can approach the authority and make a complaint to that extent. And the authority will then take it to the next level in terms of enforcing it against the company, asking questions. And if the authority is not satisfied, it has got the power to enforce penalty. There is also a section on mediation, which could also be used by the authority to mediate between the user and the company in question. So there is a bunch of options available to us. This is not really like a class action sort of a situation that you see in the EU where you get large amounts of compensation per se. Largely, this is just corrective measures that the authority can enforce, including by way of penalties on these companies, asking them to stop intrusive data processing, give specific remedies or results to the user per se who is aggrieved, etc. So that's largely the sort of complaints that you can pursue and the remedies that you can obtain from the Data Protection Authority.
Nikhil, thank you so much for joining me.
Thank you for having me.
That was the core report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in, and thank you once again for listening.